Good evening, everybody. Again, my name is Ian Latimer, and I'm a project manager on NYSERDA's Clean Energy Siting team. It is my sincere pleasure to welcome all of you to the final of our 5-part webinar series entitled Battery Energy Storage Systems, Key Considerations for Local Governments. As you know, tonight's session is focused on assessments and taxation for battery energy storage systems. And again, it is going to be the last in the 5-part webinar series. And we thank you so much to those of you who have been able to attend some or all of the sessions to date. It's been a real pleasure. And again, thank you for your time. Next slide, please. Just a few housekeeping considerations before we kick off this evening's webinar, and apologies for anyone who's now heard me say these 5 times. Members of the public are muted upon entry, and any questions and comments that you have throughout tonight's webinar can be submitted in writing through the Q&A feature in WebEx. If you'd like to take just a brief moment to locate where that is so that you can throw in your questions at any time. We would encourage attendees to submit your questions as they come up throughout the webinar rather than waiting till the end, just to make sure that we're able to best answer as many questions as possible. You'll note that there are going to be slide numbers on the bottom right of the slides, I believe, and if that is the case, you're able to indicate what slide your question is most relevant towards so that we know how to best answer it. The chat feature is disabled, so the Q&A feature in WebEx will be the best opportunity to throw any comments or questions for the presenters in WebEx. Today's materials, along with recording of the webinar and recordings of the previous webinars in this series, will be posted on our website at www.nyserda.ny.gov/storage guidebook. It's under the local government trainings header, and we'll include a link to that again later in the presentation. Finally, if any technical problems arise throughout the presentation tonight, please contact my colleague Sal Graven, who is with us providing technical support. And my sincere thanks to Sal and John, who have been providing technical support throughout this whole webinar series. We couldn't have done this without you. You can reach Sal at his email on the screen there. It's sal.graven@nyserda.ny.gov. And with that, next slide, please. Just to provide a quick recap of the series to date for anyone who's only been able to make some of the sessions or none of them, we began back in the early May with Battery Energy Storage Systems 101, featuring Dr. Stan Whittingham, a 2019 Nobel laureate for chemistry and a professor at University of Binghamton. Very fortunate to have Stan, and that's a great session. We followed that up with a fire safety course presented or featuring representatives of the New York State Office of Fire Prevention and Control, as well as the Energy Safety Response Group. We followed that up with a session on zoning and permitting for battery energy storage systems, featuring myself and my colleagues here on the Clean Energy Siting team at NYSERDA. From there, we had a session on decommissioning and end-of-life considerations for battery energy storage systems. That was just a couple weeks ago, featuring representatives of DNV and Li-Cycle, a New York-based lithium-ion battery recycler. That was a great session as well. And finally, we're thrilled to be rounding out this series with taxation and assessments, featuring a trio of great representatives from Hodgson Russ, who I'll be pleased to introduce in just a moment. Next slide, please. A quick agenda for tonight's session. We'll begin, as we have for the last few sessions, with a quick recap on energy storage in New York State, as well as the material covered in this series to date. And from there, we'll go on to the meat of tonight's session, which will be assessments and taxation. We'll begin with a coverage regarding sales tax and how that applies to battery energy storage systems, followed by property tax and battery energy storage systems, and finally, assessing battery energy storage systems. At the end of that, we will have a facilitated Q&A featuring my colleague Bill Obercare of NYSERDA's Clean Energy Siting team. So please stick around, and as I said earlier, please feel free to throw any questions that you have about the material tonight right in the Q&A function so that we can get to it. It is my distinct pleasure to introduce our speakers for tonight. As I said before, we've got a trio of really great folks here from Hodgson and Russ who are here to talk to us about these topics. In order that they'll be presenting tonight, it's my pleasure to introduce first off Joshua Lawrence. Joshua is a partner at Hodgson Russ who concentrates his practice on state and local taxation, focusing on New York State and New York City tax matters, as well as multi-state tax planning. He represents clients in audits and disputes with the New York State Department of Taxation and Finance, as well as the New York City Department of Finance. Joshua has significant experience handling sales tax planning and controversies, and with tax issues confronting the construction industry in particular. He's represented construction contractors, subcontractors, building owners, and architects on sales tax audits and related matters. And Joshua, it is my sincere thanks for joining us this evening to present. Following Josh tonight, we'll have Milla Buckner. As a senior associate, Mila regularly advises clients on issues including environmental law, renewable energy, sustainable development, land use law, municipal law, and real estate development. And her experience includes drafting commercial agreements relating to the purchase and supply of power, electric interconnection, and other energy-related transactions. And finally, as we will learn tonight, Mila has an in-depth understanding of New York real property tax law as it relates to renewable energy projects, including RPTL 487. And before joining Hodgson Russ, Mila practiced energy regulatory law with a firm in California. And so Mila, my sincere thank you for being here with us tonight. It's a pleasure to have you. And last, but certainly not least, we have Henry Zomerfeld, also a senior associate with Hodgson Russ. Henry concentrates his practice in environmental, energy, and municipal law. His practice includes representing businesses and municipalities in a variety of commercial and contract-based litigation, as well as advising clients on regulatory compliance, regulatory enforcement actions, and environmental risk assessment issues. As part of his practice, he does advise developers of renewable energy projects across the state on real property tax implications, including, again, RPTL 487 exemptions and payment-in-lieu-of-taxes, also known as pilots. Finally, Henry has represented a number of taxpayers, including renewable energy developers, municipalities, and school districts in proceedings under Article 10 of the real property tax law. And if those bios don't get you excited for them, I don't know what will. I know I'm certainly excited to hear from them. So again, to the three of you, thank you so much for joining us tonight, and we'll look forward to hearing from you in just a few minutes. But before we do, I'm going to provide a quick recap of energy storage in New York State and the material covered to date. Next slide, please. And we'll go one more. It's hard to talk about battery energy storage without touching on the Climate Leadership and Community Protection Act, also known as the Climate Act or the CLCPA. The Climate Act was signed into law in 2019, and it's a nation-leading piece of legislation which signified New York's commitment to fighting climate change, transforming our economy, and building resilient communities. Now, a couple of key things from the Climate Act that we're going to sort of touch on here as a precursor to the conversation around energy storage. There's a couple of things. Number one, there's a few energy sector goals for the state of New York that we need to hit. And the first one is going to be a 70% renewable electricity by 2030 figure, followed by a 100% emissions-free grid by 2040. Now, in order to enable achieving those goals, there are technology-specific goals that will allow us to get there, primarily 6,000 megawatts or 6 gigawatts of distributed solar by 2025, 9,000 megawatts of offshore wind by 2035, and, important to tonight's material, 1,500 megawatts of energy storage by 2025 and 3,000 megawatts by 2030. Now, it's likely that we'll need to go above and beyond those targets, but those are the baseline requirements that we are legally required to hit as a result of the passage of the Climate Act. Now, next slide, please. A brief intro on what we talk about when we talk about energy storage systems. Now, we're really talking about energy storage as a way of converting energy that's stored to electrical energy. Now, that comes in a few different shapes and sizes. Sometimes that's hydroelectric energy storage. But really tonight, we're going to be, also mechanical, like flywheels. Those are sort of other examples. But we're really focused on battery energy storage systems because batteries are the most common and flexible type of energy storage system in the market. And within battery energy storage systems, lithium-ion batteries are the prevailing chemistries for energy storage systems. The photos at the right give you sort of an example of what we're talking about when we talk about storage systems. On the top left is an example of a residential system, which is often going to be paired with like a rooftop solar array on your home, which is usually in the kilowatt hour range. Below that is an example of a commercial installation from Westchester County, which is going to range from maybe the kilowatt hour to megawatt hour range. This one is located in a business park and is providing power services to the buildings there. And then on the right is a utility scale battery energy storage facility up in the capital region of the state. I believe it's a 20 megawatt or 80 megawatt hour system. So again, it'll be in the megawatt hour to gigawatt hour range, and it's going to be providing grid services, which we'll talk about in just a moment. When we sort of break down energy storage to its most granular components, we're really talking about cells, modules, and racks. Those are the building blocks of these systems, as well as the battery management system, which acts as the eyes and ears of your system, and monitoring safety and balance of system equipment. Next slide, please. I apologize, I will have to speed through a couple of these. But really the idea here is just to showcase that there are a number of key use cases for energy storage that are either already being used or are being explored in New York State today. From the utility and grid perspective, there's a few key advantages, such as deferring costly upgrades to distribution and transmission infrastructure. It also can help support the integration of renewable energy generators that are intermittent, such as solar and wind, meaning solar is only producing when the sun is shining, wind is only producing when the wind is blowing, but that doesn't necessarily align with when the electricity is needed. So energy storage can provide that sort of arbitrage to make sure that the power is being used most efficiently. They also can alleviate congestion in the grid, including reducing brownouts and blackouts, which is particularly relevant to people right now in the weather that we're having. You know, we're seeing a lot of brownouts based on storms and based on the heat. And finally, at the more residential and commercial level, we're seeing energy storage used for electric bill management, including reducing demand charges and time of use charges. Next slide, please. Very briefly touching on this, NYSERDA does have an energy storage incentive program, which administers funding for projects. It's broken up by the retail program, which is for projects under 5 megawatts, and the bulk storage program, which is for projects over 5 megawatts. Currently, the bulk funding is fully allocated, and the retail funding still has funding available on Long Island for residential and commercial projects, and Con Edison, Westchester territory, just for commercial projects. Next slide, please. A quick snapshot, as of April 20th, we had just over 115 megawatts of installed energy storage capacity in the state, which comprises over 1,100 projects. And as far as the pipeline goes, there's an additional 1.02 gigawatts of storage that's contracted and under development, representing over 100 commercial and bulk projects. My apologies, but I'm going to skip through this a bit quickly. Next slide, please. Really quickly touching on the fire safety piece. And again, I'm not doing it justice, but you're more than welcome to go look at the materials and recording from these sessions. A couple takeaways from the fire safety webinar. We did talk about how the codes and standards in New York State have already been updated and evolved with the technology, meaning that for our municipalities out there, there are significant protections for energy storage built in under the 2020 New York State Uniform Code, which doesn't require local adoption outside of New York City. Additionally, certain projects will be required to administer large-scale fire testing to ensure that we know how systems will react in the event of failure and can plan accordingly, which is the best thing we can do for mitigating the safety risks of any of these systems. And finally, please stay tuned for a forthcoming training for fire officials and first responders, which we're putting in together with the New York State Office of Fire Prevention and Control. Next slide, please. We'll skip through this one, but I'll just say that we have resources for municipalities, including a model zoning ordinance and additional information about energy storage systems, which you're more than welcome to check out in our battery energy storage guidebook for local governments. Next slide, please. And this is my last. In our last session, we again talked about decommissioning and end-of-life considerations. And the key takeaways here are really that decommissioning for these systems is really multifaceted. We're not just talking about unplugging these systems. It's about removing them from service, disassembling, disposing of, and again, restoring or remediating the site where they're located. So it's a multifaceted issue. Decommissioning plans are required under the Uniform Code, but again, they can be supplemented by local law requirements. And I would encourage people, especially our local government representatives listening, to look at the decommissioning sections of the model law in our guidebook. And then finally, when it comes to recycling, the really key takeaways are just that recycling is evolving in response to increased demand and uses for batteries in our modern world. We are moving towards a circular economy of component recycling and recovery. And our speakers from last week, Lifecycle, are actually currently in the process of putting together the largest recycling operation for lithium-ion batteries in North America, which will be located out of Rochester, New York. So we're really excited to have them here in state, and we're really grateful that they were able to join us. And with that, I will go ahead and stop. We can go to the next slide, please. And I'm very pleased to turn it over to our great speakers from Hutch and Russ. Again, thank you all for being with us here tonight, and we look forward to your presentation.
Thanks very much, Ian. Henry Zomerfeld here. I'll kick it off and start with an overview. If we could have the next slide, please. So we're grateful to be here. We're grateful to NYSERDA. We're grateful to all of you for this last webinar presentation. Before we jump into the meat and potatoes, if you will, of tonight's webinar, I want to introduce all of you to the firm and to the Renewable Energy Practice Group at Hodgson Russ. At Hodgson Russ, we are a full-service law firm with over 200 attorneys practicing in all major areas and facets of U.S. law. We're based in Buffalo, New York. There is our headquartered building and the Guarantee Building, where I'm sitting right now. But we have offices across New York, as well as in Florida and Hackensack, New Jersey, and Toronto, Canada. And we have a really rich and deep history. We were founded in 1817. Among our notable alumni are two former US presidents. We were integral and instrumental in the completion of the Erie Canal, the Robert Moses Niagara Power Plant, the City of Buffalo City Charter, as well as the founding of Wells Fargo and Citibank. And we've been involved with so many projects and developments since then. And we've been recognized for our excellence in National Law Journal, Chambers USA, best lawyers recognized as best law firms, and our colleagues recognized as best lawyers in America, best branded law firm in 2019, and among AmLaw 200 the past few years, with rankings as well as 10th in the A-list for female equity partnership. And our lawyers have also been ranked as super lawyers with Thomson Reuters. So we're very proud of our firm, our colleagues, and what we do and the clients we service. Next slide, please. What we do is part of the renewable energy practice. We are a multidisciplinary team that works every aspect of a project's life cycle, start to finish, with strategic planning, with permitting, regulatory aspects, and environmental review. Our folks in real estate handle the financing side, as well as lease and easement agreements and title insurance and curatives, as well as other agreements related due diligence. Our corporate folks handle the corporate structuring and collaboration, and our colleagues in insurance also are involved in these projects. And naturally, what we're here to talk about tonight is taxation, with a little bit of litigation on the assessment side. So we really do cover a full array of everything that these projects need, everything that our clients need to see these projects start to finish. We have experience with wind, solar, energy storage, landfill projects, electric vehicle infrastructure, as well as decarbonization strategies and advice. We've represented developers, lenders, landowners, permitting and development agencies, as well as manufacturers and other clients, all involved with renewables. And we have international experience. We've counseled foreign entities who are participating in the US market. We have cross-border finance experience, compliance, tax treaty, and international taxation experience. So it's a wide array of what our colleagues do for renewable projects and for our clients in this space. Next slide, please. In terms of what we're going to present on tonight, we'll begin with the sales tax liabilities and exemptions, covering what exemptions, if any, apply in the course of installing facilities, private and public ownership, permanent and temporary issues, standalone and integrated storage systems, and the overall sales tax treatment of energy sales. We'll then pivot to discuss real property tax treatment, the exemptions available under the real property tax law, as well as through IDAs, standalone versus integrated systems that are part of solar or wind, issues behind the meter, negotiating pilot agreements, and then the treatment of energy storage within New York City and the regulatory scheme in the city as compared to the state as a whole. And then we'll turn to the methodology for how these projects are assessed and should be assessed, really focusing on the two methods that we are seeing that are appropriate. One, income capitalization, which preview will be what we contend is appropriate, and then cost basis, which we are seeing some jurisdictions using, and then just a discussion of whether batteries and these systems are taxable as real property or not. And we'll conclude before we get to the Q&A portion about discussing challenging and litigating real property tax assessments. Next slide, please. So with that, I'll turn it over to my colleague, Josh Lawrence.
Thanks, Henry, and thanks, Ian and NYSERDA, for having us. I hope this discussion of taxation is of benefit and of interest to you guys. if my light goes off and you see me swing back wildly, it's because I have a motion sensor on my office lights, and it's happened before in evening presentations where after 6 the lights go off and you have to move to turn them back on. So it's not having a seizure or anything like that. It just happens sometimes. So I'm going to start off our presentation with a discussion of sales tax and its applicability to energy storage systems. Now, the discussion is going to be a little bit academic because the bottom line is that energy storage kind of falls into a dead zone when it comes to sales tax exemptions that would otherwise apply to players in this field, including energy generating facilities, solar facilities, wind facilities, and traditional generating facilities. Often there are exemptions that can benefit significantly those types of projects, but energy storage kind of falls outside of the of those exemptions, and we'll explain a little bit why. But the upshot, I think, is that this lack of the ability to claim exemptions on the hard costs of installing systems is what we've seen drive most private developers of energy storage systems to seek the guidance of local industrial development agencies, IDAs, which we'll touch on a little bit later, because essentially the involvement of an IDA can turn a 7% to 9% sales tax cost on the hard costs of development of these systems into basically zero sales tax. But just to back up a little bit and discuss what these exemptions are and sort of where battery energy storage fits in, we can just talk about sales tax in general. And the general rule in New York is that any sale of tangible personal property is presumed subject to tax unless a specific exemption applies. Services are also taxable as long as they're specifically enumerated as taxable in the tax law. And again, if they are, unless a specific exemption applies, tax applies. Tax also applies to the sale of utilities, including gas, electricity, refrigeration, and steam. And there are a few other, taxable transactions which aren't relevant here. But the exemptions that we're going to discuss are listed here on the first slide. The production manufacturing exemption is essentially an exemption that is applicable to machinery or equipment that's used in manufacturing a product for sale. And that includes generating electricity for sale. And the general thinking, behind the exemption is that if a taxpayer is going to be producing something that's taxable and generating sales tax revenue for New York, they should have a exemption for the development costs or the cost to set up that activity. There's another exemption which involves more broadly general construction on real property. And essentially it's an exemption to the tax that would normally apply on installing tangible personal property. If it meets the test as a capital improvement, the costs to install are exempt. There is a very generous exemption when construction or development is performed for a tax-exempt entity, which includes governmental entities, municipalities, charities, any tax-exempt entity. It covers not only the cost of installing the development, but also any costs in acquiring the materials, whether by the exempt entity itself or the contractors working on site. And then finally, although it's not really applicable just by letter of the statute to energy storage, there is a exemption for commercial solar energy systems. I'll just touch upon that briefly at the end because it's not really too relevant to the projects here, even co-located energy storage that might be associated with a solar energy system. So next slide, please. Okay, so the production manufacturing exemption, there are a few elements that have to be met in order for this to apply. And as we go through them, it might become apparent why battery energy storage might not meet some of these. So under the statute, the equipment has to be used directly and predominantly in the production of tangible personal property, or in this case, electricity, for sale, and I actually should have underlined for sale because that's another requirement, by manufacturing, processing, generating, etc. So essentially, in order for energy storage to meet the exemption, the equipment would have to be directly used for most of the time it is used in the generating phase of electrical production. And so if you look at the regulations, they focus on different phases of the manufacturing process. And the idea here is that a manufacturer or generator or another person that might be eligible can't claim the exemption on every single thing it purchases. It has to be related directly to the production phase of producing whatever product is we're talking about, and it has to be used more than 50% of the time in that capacity. And essentially, when we talk about production, it means essentially the assembly line, the actual process of producing the product that is finished and packaged for sale, and anything subsequent to that is considered to be in a different phase, and that includes storing, displaying, selling, loading, shipping finished products. And if we go to the next slide. So the tax department, the New York State Tax Department, has basically issued guidance in the form of at least 2 rulings out there that kind of make it clear that energy storage is not going to fall under this exemption, which otherwise could be pretty lucrative for an energy generator, a solar generating facility, traditional generating facility, or wind facility. The first of the 2 rulings we're going to discuss was in 2009, and it was actually issued to the developer of a flywheel system, who asked whether the system and its installation would qualify for the exemption. The tax department basically said no on 2 points. One was that the activity was not really generating electricity for sale. It was to regulate power on the grid, to take power off the grid, to supply stored power to the grid, and it wasn't generating electricity for sale. And the department went further to say that even if a energy storage provider, or this energy storage provider, could be deemed a generator, the system was designed such that less than 50% of the time would it be putting power back onto the grid, unless it would fail that predominance test. In 2013, the department issued a ruling which was very informative as to what the department considers to be the production phase when it comes to generating electricity. And it was issued to the developer of a solar facility. And it sort of took each aspect of the solar facility and determined whether, what phase the equipment was related to, and distinguished which would qualify for the production phase and which would not. And essentially, on a solar generating facility site, the panels, the connection to the inverter itself, and certain controls for the panels would all qualify. But in the department's view, anything beyond the inverter and potentially an on-site transformer would fall outside of that production phase. And the upshot, even though energy storage or co-located storage unit on the site wasn't addressed, the implication is that that would fall outside of the production phase. And the slide shows sort of what the different types of equipment would be, and which would qualify and which wouldn't. So that's essentially the production phase. And if we go to the next slide, we'll talk a little bit about capital improvements. The capital improvement exemption, assuming a project qualifies as a capital improvement, can be very, can save a ton of money, because it essentially exempts all contractors' charges for furnishing and installing the materials to construct a project. The exclusion is actually an exclusion from the service installing tangible personal property, and if that installation results in an improvement to the property that meets a 3-pronged test, all charges are exempt. That test requires that the property substantially add to the value of the real property or appreciably prolong its useful life. It has to objectively become part of the real property in a way that it is permanently affixed, and the test there is would removal of that installation cause significant damage to the property itself or the real property on which it's installed. And then third is a more subjective test, which focuses on whether the installation is intended to become permanent. And as we'll see in a second, that's kind of the death knell for a lot of projects that we see that are on leased property, which a lot of energy storage projects are. And just a note that in talking about the capital improvement test, it doesn't matter whether in another area of the law, such as the real property tax law, something is determined to be real property. That doesn't affect whether it qualifies as a capital improvement for sales tax purposes, and vice versa. The sales tax designation doesn't control real property tax. Next slide. So the question on capital improvements is, are the three prongs met? Now, the first two prongs, if we were talking about installation on an owned site of a storage system, it's likely that the first two prongs of the test could be met for a lot of the installations, foundations, fencing, access roads, the housings, possibly for the batteries. Whether the batteries themselves would qualify is not necessarily clear. It would depend on how they are attached. The department essentially takes the position that anything that's just bolted down to a foundation and can be removed easily without destroying the item itself or damaging it, it could be used elsewhere, it's not going to qualify. But if we're talking about installation on a leased site, there's an even bigger problem, which is the third prong. And the problem there is that the department's position is that leasehold improvements, as opposed to improvements made by a property owner, are presumed to not be intended as permanent installations. Now that can be rebutted. The only problem is that the lease terms are usually what govern that presumption, and a requirement in a lease that the property be removed at the end of the term or decommissioned will generally defeat the applicability of the capital improvement exemption. So the bottom line for the hard costs of constructing a facility to house a battery storage system is that it's not going to qualify for the production exemption, and if it's on leased property, it's unlikely to qualify as a capital improvement to real property. So next slide. So the exempt organizations portion here is very important. The tax law allows tax-exempt organizations a very generous tax exemption. Any work that is done on property owned by an exempt organization, which includes governmental bodies, municipalities, U.S. governmental bodies, nonprofits, etc. Any work on real property that's owned by an exempt organization is not only exempt in terms of the charges to the organization, but it also allows contractors that are working on the site to purchase all materials that are going to be incorporated onto that project owned by the exempt organization tax-free. So you get an exemption at both ends of the spectrum there. The problem is that how does a private developer take advantage of any of that? And that is where the Industrial Development Agency option comes into play. And Mila Buckner in the next segment is going to talk a little bit about IDAs, but the idea there is that an IDA technically becomes the owner of the property during the construction of the project, and therefore all exemptions that are available for exempt organizations kick in, and not only is no tax due on the charges to the developer for developing the project, but the materials that contractors have to purchase and subcontractors have to purchase can also be purchased tax-free, so they don't add to the cost either. And the way that it technically works for sales tax purposes is that the IDA appoints the project developer as its agent, and so that agent steps into the IDA's shoes as an exempt, as buying for the exempt governmental organization, and that's how the exemption works. And other contractors or subcontractors can also be appointed as agents as well. And so the effect under a successful IDA arrangement is that regardless of the non-applicability of other exemptions, the sales tax can be almost completely eliminated on the hard costs of development. So next slide. And so I'm just going to very briefly talk about this exemption for commercial solar systems. Just by definition, it doesn't apply to energy storage. It specifically applies to solar energy systems. And although there isn't too much guidance on interpreting the statute and its applicability, based on our research, it really isn't broad enough to cover even a storage system that's installed at a generating facility. So there's really not much applicability here, but I mention it because there has been legislation introduced. It was introduced 2 years ago. It hasn't moved, but legislation has been introduced to provide essentially the same exemption, but specifically for energy storage systems. And like the exemption for commercial solar systems, local jurisdictions would have the option to opt out of providing that. So it may just be a state-only exemption if it were ever passed, depending on which municipalities or local jurisdictions decide to apply it. So just to sum up, as I said, this is why we see battery energy storage systems going straight to seeking the assistance of IDAs, because again, you're talking about a 7.5% to a almost 9% sales tax cost on the development, unless you can get this sort of intervention of an exempt organization into the picture. And Miller will talk a little bit more about the benefits of an IDA arrangement for real property tax purposes. And any questions on the sales tax aspects we can address at the end if there are any questions. So with that, I guess I will pass it on to Miller to talk about the real property tax implications.
Great. So I'm here tonight to talk about some of the real property tax exemptions that are available for renewable energy projects, particularly batteries. So the first one worth mentioning is RPTL Section 487. Under that real property law, there's a 15-year tax exemption for various renewable resources such as solar, wind, as well as battery storage, among others. Under the RPTL 487 exemption, it exempts the taxes that would otherwise be owed due to the incremental improvement on the real property. However, you do still have to pay special taxes and ad valorem levies. So in New York, that's most often fire, water, sewer, those sorts of things. Sorry, could we actually go to the next slide? Maybe the next two slides. Great. And actually at this point we can move on to one more slide. So the RPTL 487 exemption for batteries is found in subsection 1M and 1N. So again, just making clear that this statute's available for those resources. Next slide. So when you obtain the RPTL 487 exemption, you have to make a filing with the town assessor. And in doing that, you fill out a form that's referred to as the RP 487 application. And in that, you're going to include a description of the project, the date the project was completed, the cost of the project, and the incremental cost of the site. In doing so, you're putting it before the town assessor to make a determination on it, and that has to be filed before March 1. In most jurisdictions, it's March 1 of every year to go on so that the tax exemption can be applied to the tax roll for the following tax year. So once that's submitted, the tax assessor will review it and either grant or deny the exemption. In my experience, I've never seen one denied that had a proper pilot agreement and information filled out, but nevertheless, it is technically a discretionary action by the town assessor. Can we go to the next slide, please? So again, the exemption only stays in place so long as the property is being used for an exempt purpose. So if you were to remove the system before the 15-year period, then the exemption would go away. It's also worth noting that the RPTL 487 exemption applies for projects that are in use prior to January 1 of 2025. So technically there's a cutoff date, but there's a suspicion that that could be extended by the legislature as we grow, get closer to that year. Can you go to the next slide, please? So one thing that's very unique about RPTL 47 is there's an opt-out provision. So when the law was adopted by the state of New York, it applied universally to all municipalities. However, the city, town, village, county, or school district could elect to opt out of the law. And if they do so, the exemption is no longer available and the system would be taxed at full value. So if you go on the Department of State website, or you even just Google RPTL 47 opt-out, there's a list available of all the communities that have elected to opt out. And when you're thinking about developing a project, it's really important to take a look at that list and consider those jurisdictions where the exemption is no longer available. Again, you're paying full taxes to the jurisdiction when that's the case, which can be sort of a project killer, particularly where the school district is involved. Generally speaking, the school district carries about 70% of the tax burden, the county maybe 20, and the town about 10. So you want to think about that when you're negotiating an agreement. I will say it's become popular in New York for taxing jurisdictions to opt out preemptively. There's another caveat in RPTL 47 where you need to send a notice to the taxing jurisdiction informing them of your intent to construct a renewable project within the community. And that starts a 60-day window in which they must respond, indicating their intent to require a pilot payment. And if they fail to respond within that 60-day window, they've lost out on their right to tax the project and be a party to the pilot agreement. So I think we've seen this trend in New York of jurisdictions opting out as sort of a defense against that 60-day window clock. Sometimes jurisdictions fail to get the notice or they're confused about the process, and in doing so, they lose the ability to tax the project. So in some communities, it might appear that they're opted out, but if you approach them and ask, if a deal can be made, they may be willing to opt back in and grant something for the project, particularly depending on how you structure a pilot payment or pilot agreement. Sometimes a deal can be struck, so it's worth looking into. Can we go to the next slide, please? So as we previously mentioned, there's another option for real property tax exemptions for battery storage systems. These can be provided by industrial development agencies under their uniform tax exemption policies, or UTEPs. They can oftentimes grant not only real property, but sales tax and mortgage recording tax exemptions for these sites. An IDA can be attractive for a number of reasons in addition to those additional tax exemptions. They can also provide a longer term. So rather than just the 15 years that we see under RPTL 47, they can do 25 or 30 years or something that's more in line with the life of the project. And I've seen a lot of financiers and banks be particularly attracted to the IDA model because it gives you more certainty over the tax burden on the project. With RPTL 47, there's that steep cutoff right at 15. where the project goes back on the tax roll and will be assessed at full value. So you can do a depreciation and create a model sort of estimating what you think taxes will be in year 16. And of course, taking into account the depreciation of the equipment, but nevertheless, there's still sort of that variability. So some lenders much prefer the longer tax exemption term that can be provided for under the IDA. The only thing worth mentioning there is that most IDAs charge an application fee. It's roughly 1% to 2% of the total project cost. So that can be pretty significant. And sometimes a deterrent. There's really no transaction cost with an RPTL 47 pilot agreement. It's just sort of the legal fees and the time it takes to negotiate it. But here with the IDA exemption, it's pretty significant. So just pros and cons to be weighed between the two options. Next slide, please. So one other exemption worth mentioning is a specific tax abatement for energy storage projects in New York City. This is found under RPTL section 499 BBBB. So here there's a tax abatement for energy storage equipment worth the lesser of 10% of the expenditures on the equipment, or the amount of taxes payable in a single tax year, or $62,500. So really the exemption here is capped at that $62,500 price tag. So it's a pretty minor sort of drop in the bucket dent on the overall tax burden that you could see on these projects. RPTL 47 is, by comparison, could take care of the taxes otherwise owed on the project in total. So it's a much better exemption, but still worth noting that New York City has some specific things available for energy storage projects. Next slide, please. So one other thing to note, I mean, I sort of touched on this already, but under RPTL 47, you're going to be negotiating a payment in lieu of taxes agreement, also referred to as a pilot. So that's an individual agreement with a taxing jurisdiction that spells out the dollar amount that will be paid instead of taxes. So in New York, that's going to be a negotiation of the dollar per megawatt AC payment for the total capacity of the system. And unfortunately, there's a huge amount of variability in these pilot agreements. NYSERDA puts out standard guidance on what they think the benchmark should be for projects depending on the utility service territory, and also the valuation of the system. But more and more, we're seeing that developers aren't really taxing jurisdictions aren't really relying on that guidance and are kind of negotiating these agreements based on their own opinions and sort of other things that have happened in the market. So it's important to understand that each of these pilot agreements is really an individual negotiation. There's certainly benchmarks in a robust pilot market to turn to and reference, but at the end of the day, it's really between the developer and the individual taxing jurisdiction to reach an agreement. It's also worth noting that there's no pilot mandate for standalone storage systems, but we're certainly seeing these agreements be negotiated for all sorts of renewables. Can we go to the next slide, please? So in terms of like a favorable pilot agreement, again, it's going to be $1 per megawatt number that you offer to the taxing jurisdiction. The term is always going to be for 15 years. You would want to think about other provisions that are included in the pilot agreement, including the assignment clause. Typically, the pilot agreement is entered into by the project LLC and is sort of freely transferred when you sell the project LLC. The pilot agreement goes with that, so you don't have to worry about reassigning the agreement once the project's sold, but things like that are important to pay attention to. You also would want to include a right for the developer to terminate the pilot agreement. In some instances, as time goes on, you might find that full taxes is cheaper than what the pilot agreement payment provides for. So in year 13, 14, 15, you may decide that it's more profitable to rip up the pilot agreement and pay the equivalent of full taxes at that point than continuing to pay under the pilot agreement. So just some additional considerations to take into account. Next slide. So finally, we just wanted to provide an example of a pilot agreement that was recently negotiated in Orange County. This was a solar plus storage pilot. It was a 5 megawatt solar project with a 15 megawatt energy storage system attached to it. And there we saw a pilot agreement for $10,000 per megawatt for their solar system, plus additional $500 for the battery project. And that included 2% escalation over the 15-year period. And in negotiating that, the jurisdictions assumed about a $1 million valuation for the battery project. And that to us is a very fair pilot agreement. We would encourage other developers to sort of point to that as a good industry standard for how these projects should be treated. But as time goes on, I think we're going to see a lot more pilot agreements for these sites and hopefully have additional benchmarks. So with that, I think we'll wrap up the discussion on real property taxes and allow Henry to address a few more things about assessment.
Thanks very much, Mila. If you could advance to the next 2 slides. So we're going to skip the next one and go right to the second. So as Mila indicated, as I indicated in the overview, we'll now turn to how energy storage is actually valued for assessment purposes and what is real property for the purposes of assessments. So real property is in New York, whatever the legislature has said it is. And there are multiple definitions of real property under RPTL section 102. Relevant here, 102 subdivision 12, relevant here is 12B, which indicates, among other things, structures are real property, as well as all things that are affixed to buildings or structures. Now, when we talk of real property, quote unquote, that is to distinguish it from personal property, which personal property is not typically taxable under New York law. Energy storage is considered a fixture generally, and thus it's deemed real property and therefore taxable because it's a fixture. And that comes out of the Metro Media case back in 1983. It was a case involving billboards, and that really talked about when a structure is affixed and what the common law definition of fixture is. And basically, there are 3 key elements. Relevant here is whether or not it's permanent and annexed to the real property. Next slide, please. So when we discuss assessments and valuation, there are several methods that assessors and appraisers would use for property of this nature. It comes down to the cost approach and the income capitalization approach. Under cost, which is sometimes known as reproduction cost, new less depreciation, RCNLD, this is a disfavored method in New York. The courts are reluctant to apply it and sometimes even outright reject it, particularly when a property is income producing. And that's because the cost method tends to overvalue. And because of that risk inherent to using the cost method, if there is an opportunity to use an alternative method such as income, or if there are comparable sales, appraisers and the courts would likely look to those methods and not rely on cost, because cost is really relegated to unique properties where there is no market. And those unique properties are deemed specialties. And those properties are the ones that the courts will use the cost method for. They're very limited in nature. I know there are cases out there involving landfills where landfills were deemed specialties, sometimes under statute. For instance, special franchise property involving cables and fiber optics would be cost method, and that's by statute. Here, at least unofficially, New York City has indicated that energy storage would be valued by cost, and we would submit that that's not appropriate. The market is growing for these properties. If there is an income stream, so cost would not be appropriate here. Next slide, please. Is it really allowable to use the cost method? And that question really goes to, is there really no market for energy storage? You know, in light of the Climate Act, in light of jurisdictions being more favorable toward renewables. And in jurisdictions like New York City, where there isn't much opportunity to have alternatives, but to rely on storage. There's some, of course, solar, but storage is really going to be the way for those large metropolitans. And that market is growing, and years from now, it's going to be growing. So to say that cost would be appropriate, I think is defiant of what the market is actually demanding now and what we're seeing. It also, we have to look at the recently enacted RPTL 575B assessment model. Now, 575B requires solar or wind to be assessed based on discounted cash flow method. Now, the model and the rates have not yet been published. We're expecting those to be published in the fall, but we're not certain of that. This is the inaugural year for the model. And it doesn't mention energy storage. However, we think this is going to be instructive for appraisers and assessors who may say, if we're going to use discounted cash flow, which is sort of a cousin of income capitalization, what are the rates that the Department of Taxation and Finance, what are they publishing, what are those rates, and how are those going to impact appraisals, and how are those going to impact assessments generally on renewables? We don't know yet how it will play out for energy storage exactly. There aren't many challenges yet in litigation, but we do expect court cases to arise. Next slide, please. So now we'll talk about the income capitalization method. And when a property is income producing, this is typically the preferred method. You take your income, you deduct out your expenses, you get your NOI, your net operating income, and then you apply a capitalization rate to get your value. The key is a capitalization rate is really an art more than it is a science, and appraisers and assessors and even attorneys who are involved in this type of litigation where income capitalization method is used will build cap rates differently using different factors. So really, understanding how the cap rate is built is half the battle, and that's why it's important to understand not only the methodology used, but what comprises that methodology. A lower cap rate implies lower risk. A higher cap rate implies higher risk. And how that plays out typically is if you want a lower assessed value, you want a higher capitalization rate typically. And when renewables generally where we saw more appraisals on them, cap rates were coming out at around 8%. We're now seeing them more in the range of 14%. And that is, 8% just really wasn't realistic. But it's important to understand that the cap rate is not the return on the investment. It's a market-based rate that takes into account a number of factors. And appraisers will use the Uniform Standard of Professional Appraisal Practice, USPAP, and the guidance and the requirements under USPAP in creating and loading their cap rates. Next slide, please. So when we're dealing with energy storage, there are several questions to consider, and these are questions to think about, but not only think about, to discuss if you're with your attorneys if you have them, with your experts and appraisers if you have them, and with the assessor if you're really trying to understand valuation and how assessments are going to be set. So where storage is part of an integrated renewable solar wind facility, is it being evaluated on the income capitalization basis? We now know 575B is going to mandate discounted cash flow for solar and wind. And again, as I noted, it doesn't cover storage. But when you have an integrated system, you're going to want to understand what methodology the assessor is using. You'll also want to understand if energy storage is part of the exemption granted either under RPTL 487 or any pilots through the IDA. And ultimately, what you want to know is when storage is truly behind the meter, is it being treated the same as the main property for assessment purposes? And what this is getting at is the distinction between real property income streams and business income streams, and understanding what it is that the assessor is using. Because a lot of times assessors are counting in certain incentives that likely would otherwise be excluded from real renewable appraisals. So you'll want to know what the assessor is actually looking at. Next slide, please. So when you have a disagreement with the assessor or the municipality about how your project is assessed, you have to challenge it in a two-part process. The first is an administrative proceeding where you have to file a grievance with the Board of Assessment Review or the Tax Commission by grievance day. And in town jurisdictions, most of them operate where grievance day is the fourth Tuesday in May. For city jurisdictions like New York City, it's a different schedule. New York City uses March 1 for certain property classes, including standalone storage, and March 15 for other classes. So when you are considering a challenge, make sure you know when grievance day is, because that is a hard deadline. And if you don't file your grievance or you don't file it timely, you will lose out for challenging that year. Once you file a grievance, there's an administrative hearing before the board sometimes. Sometimes they just decide it on papers, and then they'll issue a determination. They may, before that determination, make a request for information. They may want leases, income and expense data, etc., which you'd have to typically give them absent any reason not to, which you'd want to preserve. And then a decision is rendered, and you have 30 days from the publication of the final roll to commence a lawsuit under Article 7 of the Real Property Tax Law. And the benefit of Article 7 litigation is when an assessment is resolved and reduced, refunds are on the table for the difference that you've paid and the reduction, and is also subject to a 3-year freeze under Section 727 of the Real Property Tax Law. And that locks in that assessment for 3 prospective years. So that's a benefit. It brings some security to your assessment and to your taxes. Next slide. With that, we covered a lot in the amount of time. We're grateful to the folks at NYSERDA for inviting us. We're grateful to all of you for joining us. And with that, I'm going to turn it over to Bill to cover some post-webinar discussion. And we're looking forward to your questions. Thanks so much.
Thank you to Josh, Mila, and Henry for a really great and very informative and salient presentation. Can I go to the next slide, please? I just want to remind folks on the line that NYSERDA's Clean Energy Siting team does offer a host of resources through our Energy Storage System Guidebook. And we also do one-on-one technical assistance with municipalities and other stakeholders, and offer free accredited trainings for code enforcement. And as always, all of the materials that the Clean Energy Siting team offers, like this webinar, are both free and available for all. And we really hope that that helps folks get some responsible development and well-cited projects coming up in New York State. And with that, can we go to the next slide, please? We're going to take a brief break to just look through the questions that we have and allow folks on the line a chance to add any additional questions in the QA function. Should be at the bottom right of your screen. So we will reconvene in another couple of minutes to answer questions that folks may have. So we will be back shortly. Okay, nice to see some really great questions coming in and that have been coming in the whole time. I'm going to start with the first question for Josh, if you would be so kind as to field this one. First question we have is, what parts of energy storage systems are taxed by which jurisdictions? Sales tax versus property tax, and then the level of optionality and local control jurisdiction by jurisdictions. And we're particularly interested in the sales tax on those energy sales. I know that you touched on that a little bit, but I think a brief recap would be great.
Okay, I'm glad you read that because I didn't I didn't see that question in the list here, but I'm hoping I answer everything that was asked in all elements. But I mean, essentially, the sales tax is a transaction tax. So the sales tax applies to the purchase of the materials used to construct the project. It's not imposed sort of on the project once constructed, like property tax can be. I told you this was going to happen. So I mean, all purchases, unless there's an IDA involvement or there's some other exemption applicable, all purchases of materials used to construct the facility, and I see there was a question about sales tax and the batteries as well. The batteries would be included in that, and those can be the most expensive part of the whole project. Essentially, any tangible personal property is taxable without an exemption. And so the cost to install and the purchase of the materials, whether the materials are purchased and someone installs them, or a contractor sort of furnishes and installs, all those charges would be subject to sales tax at the time the transaction is entered into. Whereas the real property tax, is something that's ongoing, and it applies to the property once installed. Was there a question in there also on the taxation of utilities themselves and the sale of energy?
I believe there was. So what I think you might be referencing is would an energy storage system qualify even if the project is implemented under a third-party ownership mechanism such as a PPA or a tolling agreement? Is that the one you're referencing?
Yeah, and if that's a sales tax question, in that case, if the third party, involved is a tax exempt organization or tax exempt entity, if that's sort of the question, again, the applicability of the sales tax exemption really only applies to when we're talking about the development costs or the installation costs or the purchase of materials or installation costs. The only way that those could be exempted is if the exempt organization owns the property on which the system is going to be installed. And I see that there's another sales tax question down there, which is a very good one, which may be related, which asks, well, what if a tax exempt organization owns the real property, but the developer is leasing or is a tenant on the property? And there are two rulings out there that address this. Both involve JFK Airport and tenants installing portions of terminals, basically. And in both cases, the department said, yes, that still works. A tenant can install property on can install leasehold improvements that would qualify because of the ownership of the property by the tax exempt organization. But oftentimes these rulings don't really have much detail on the facts. And one of the rulings made it clear that the lease was an issue in one of those cases where the lease didn't require that the property be removed at the end of the term. And it was contemplated that, the JetBlue terminal at JFK was going to remain there and not be required to be removed. So yes, that the answer is yes. If there is an exempt organization involved and it owns the real property, there are ways to structure it so that the exemption would apply. The IDA, of course, solves that issue directly by allowing a private developer to install, a private development essentially on land that's technically owned by the IDA during construction, and therefore the exemptions apply. But there are other structures that could potentially work.
Okay, great. Thank you. And just one more question that we received kind of along the same lines is, I believe, a New York City question. Does the property tax abatement apply if the project is implemented on a tax-exempt entity's property?
If that's a property tax question, I'm going to have to defer.
Sure. Mila, would you like to pick that one up?
So I think there's another question lower down too about whether if the project was on a piece of religious property or something like that. I think the nuance to understand here is that you're going to have real property taxes on the underlying land as well as the improvement that's created by the project. So the underlying land may have an exemption based on the fact that it's like a religious organization or state-owned property or something like that, which will take care of that piece of the tax. And then the RPTL 47 exemption would take care of the taxes on the system itself. You just have to be a bit careful if you're changing the use of the property. So say you have like a religious property exemption, but then you tear down a church and put in a battery storage system, obviously that exemption is going to disappear. So you just need to be thoughtful about sort of like how to stack those to make to create the greatest savings possible.
Great. Thank you. And Mila, while I have you, I think we have one more for you. How many IDAs have programs that renewable energy projects will qualify under currently in New York?
Yep. So I can't give you a number. I would say quite a few of them have like solar or renewable energy specific programs in their UTEPs. Others will have something that's more general, like an industrial exemption, and you could approach them and see if your project could fall under that category. New York City has just recently approved 5 IDA applications for standalone battery energy storage systems. Those are all part of a public record now. So there's great precedent for going to the IDA for battery storage systems within the city. And then across the state, more often than not, you can get an exemption for a renewable energy project, but you do need to approach each IDA individually and fill out their appetite for renewable.
Great, thank you. And we actually have one more sales tax question. So if the idea is property that is put in place to generate electricity for resale is exempt from tax because the electricity is taxed to the consumer, storage seems like a no-brainer. Because of round-trip efficiency, it loses electricity. Its only purpose is to make sure that electricity is available to the consumer when needed. Just wondering if we could get your thoughts on that, Josh, in how the end user and their relationship to storage can come into play with some of these sales tax issues.
Yeah, I mean, it's totally a valid point. I mean, as I mentioned, the purpose of the production manufacturing exemption is because the equipment is contemplated to be used in ultimately creating a taxable transaction. The tax department, the legislature thought that it would be wise to grant an exemption for the costs incurred, to set up that taxable activity and to allow that taxable sale to occur. The only problem is that the statute, the way it's written and interpreted, still has those elements that have to be met, which are that, it has to be equipment that is actually directly involved in generating, electricity. And the storage just doesn't meet the technical aspects of the statute. Like I said, though, there is legislation. I don't know what type of legs it has, but there is legislation that has been introduced to provide a specific exemption for energy storage equipment, which would cover both the cost to install it and purchases of that equipment without installation, and allow contractors who are installing it to purchase it tax-free and not have to charge for the installation. It hasn't moved as far as I know since being introduced, but I think that that's in recognition that we have this important sort of component for energy, for taxable energy that's out there, and yet it falls outside of all of our sales tax exemptions.
Great, thank you. I think we have time for just one more question here, and I will leave it to the panel to decide who is best suited to handle this. And can I have the next slide, please, just so folks can have contact information for the panelists here today. And our final question for the evening is, are you aware of how many energy storage projects are in Westchester County? And then how are IDAs typically getting involved in these projects? Do they take the lead, or are they looking for a private sector partner?
I can answer that. I know that there's at least one, I'm working on one energy storage project in Westchester County. But I think that there's probably more on the way. It's a good area to be looking at in terms of load pocket and the incentives that are available for that space. The IDA is the only organization involved in the tax exemption. So I'm not sure I totally follow the question, but they wouldn't be partnering with anyone. The developer would just submit an application and the IDA would review and approve it. So you just have those two parties in the deal structure.
Great, thank you. And with that, once again, our sincere thanks to Josh, Mila, and Henry for a wonderful, very informative and timely presentation. Please feel free to reach out to Clean Energy Help at nyserda.ny.gov with any questions about the webinar series. Thank you all for attending, giving up your Wednesday nights to be with us and learn about this material. I hope everyone has a great evening and a great holiday weekend coming up. And thank you all again. Have a great night.
Thank you.